Brad, it is great to see you. The last time you and I met was in New York several years ago. And at that time, you were in the equity research markets. Tell me a little bit about the sort of transition and how you've come about to be in the focus you're doing here.
It's great to see you too, Nick, and thanks so much for having me on. That's right. I spent the better part of 20 years as an equity research analyst in the oil services space at a couple of different firms, and it was really just time to change. I suppose most importantly, to try to reorient what I was doing a little bit more towards, let's call it, the public good, to try to I could influence policy in a positive way with respect to climate change. That was a goal I felt was worth working towards. Um, but the industry, again, the services industry was fascinating, and I really enjoyed spending time there. And I still read about it a lot, and it's almost a little funny to not be involved in the day to day the way I was.
Yeah, I bet. And I mean, from a timing perspective, it's also pretty spectacular given the evolution of effort and intensity that the world has put on carbon and climate change. So let's jump straight into that. I mean, over time, you could probably argue that nothing more than sort of a change in price or setting a price has been able to drive real behavioral change in this idea of lowering emissions. And in order to do that, it requires a sort of alignment of governments and regulators and society to be able to come up with a market-based mechanism that effectively allows you to do an address of the climate change issue. So what I'm sort of curious about is if that's the case and you have this in this sort of a mechanism here and you need to create incentives and disincentives, the most important part of that is that you can create a value to that. Tell me your thoughts there.
Yeah, I think that's right. I think it's establishing a value, either imposing it, effectively a government imposing that there should be a value, and that can be done in a couple different ways, and we'll come right back to it, or society collectively figuring that out, right? So in a mandatory mechanism, government is either mandating a certain number of emissions credits or a certain emission allowance, or it's mandating a price. And in either sense, you're not really sure of the other output, right? So if you mandate an emission allowance, you're not sure what price that'll wind up, what value that'll be, or vice versa. But in either way, you are forcing behavioral change.
So, okay, so let's roll it back just a little bit, right? So, it all sort of effectively started with Kyoto, and then most recently last year we had COP26. So, tell us about the sort of evolution of this sort of market mechanism over time, and then we'll talk a little bit about those in a second.
Sure. Yeah. Well, you're absolutely right. The first carbon offset markets, and that's really the mechanism we're going to wind up spending a good amount of time on today, evolved out of the Kyoto Protocol. So Kyoto established that countries in the developed world would commit to reducing emissions. It also included creating flexibility mechanisms that facilitated cross-border investment. So the most used of the flexibility mechanisms was called the Clean Development Mechanism. I should say it's still in use today, or CDM. So in CDM, developing countries participate by investing in projects. These projects are issued credits based on emissions avoidance, so relative to a fossil fuel-based alternative of a clean development project is issued a number of credits. And the entities in developed countries can buy those credits and use them to offset their own emission reduction commitments. So CDM has been considered very successful, even if it's not huge. There's been 8,000 some odd projects, a cumulative total of about $100 billion in worth of traded since its inception in 2004. And as you mentioned, things have sort of evolved from there.
So, I mean, you say it hasn't been successful, 8,000 projects. What sort of has driven that? I mean, do you think that there's a sort of a social pullback from that? Is there an issue around the regulation? Is it participation that isn't broad-based? Sort of what's sort of holding it back?
Oh, well, I don't mean to suggest it. maybe I misspoke or I wasn't clear enough. I mean, I think it is considered successful. It's just not huge relative to kind of markets that we talk about today, right?
Okay.
In the aggregate, it's just not that large. And I think that speaks to the fact that there were other mechanisms for emission reduction targets, that there weren't as aggressive targets set as there might be. So I do think it was more of a starting point. So I don't mean to dismiss it
Okay.
in that sense. But again, maybe to segue, the idea is if it accomplished, first of all, if its primary goal was to accomplish sustainable development, so clean energy projects
Hmm.
primarily, then that's fine. But if you really pivot to emissions reduction being the primary target, then the goals that we have to set are significantly higher. And therefore,
Hmm.
you're talking about galvanizing, mobilizing a whole lot more capital.
Okay. And some of that, I guess, to what you were talking about before, is this idea of a sort of voluntary versus maybe mandatory, right? Where if you have a world where it's a voluntary mechanism, then that's a world where you as a corporate or you as a citizen can choose to sort of somehow make your contribution to that. So I could buy an airline ticket, and that airline ticket I can then pay an extra fee to offset the carbon emissions from my trip. And there's sort of lots of ways that you can log onto the internet and find ways to do that. The mandatory way, which if you look at the EU's ETS, or if you look at even, China has a system, the east coast of the US has a system, California has a system, allow you to have now a sort of a different scale, because you're also now looking at a regulated expectation. And from those schemes, you end up in a world whereby governments are imposing caps, and you can sort of trade your way through that cap, but ultimately the cap is also going down every year. And therefore, if there's fewer of those emission certificates to buy, then there's, of course, less emissions in theory that you should be able to, or that the world should be producing. So I'm interested in sort of your views on how all these different mechanisms can play a role to reduce carbon emissions.
Sure, sure. Well, everything you said was right, and you said a lot. So let's break that down a little bit, or unpack it, as people say. So, from a mandatory standpoint, again, governments have a choice. You can set a price, or you can set a carbon tax or something, or you can set emissions credits, which, as you mentioned, are often designed to say go down every year to force behavioral change, as opposed to simply being able to buy allowances. The mandatory markets, though, have been, let's call them more powerful, right? As you mentioned, Europe's ETS. I mean, the price that it's trading at is $100 per ton. Um, in contrast, the voluntary markets, the average price in the voluntary markets last year was $5 a ton. So I'm not sure that's an entirely apples to apples comparison. I don't want to suggest that it is, but I think directionally it tells you something about the power of government stepping in and mandating change versus the voluntary efforts. Now, I think it's fair to say that we're not going to see governments en masse act quickly enough relative to the looming risk related to climate change. And so I think the voluntary markets will prove to be an ever expanding and ever more important part of this puzzle.
Mm.
Um, the and obviously the societal pressures, the investor pressures, the various other forces that we are all feeling will help to kind of galvanize and offer potential for growth for those voluntary markets. And I should note that the voluntary markets have indeed been growing. Although they're still relatively small, they finally crossed over the $1 billion threshold for trading value in aggregate in 2021. I think that was something up like 30% year over year. So we are seeing pretty quick growth. It's just starting from this very small base, and it needs to accelerate.
And do you have a feeling as to what percentage that is of the mandatory market? I mean, I've heard numbers that it's, exponentially smaller, and the mandatory market is 10, 15, 20 times that. Is it
I,
more?
I, I don't have good numbers. I wish I could give you those good numbers. I've heard things similarly, and I'm not exactly sure why. It's a little hard to find that, but maybe greater transparency is one of the messages that would help kind of us all frame this a little bit. But I do sense that it is a whole lot smaller. Yes.
Yeah.
So
Okay. Because if you look at it now, right, and we assume, well, we know that we emit about 40 billion tons a year globally, which means that if we're trying to keep that to that 1.5 degree scenario, there's effectively at the current sort of rate that we've been seeing things 8 years left before we get to that magic number that the Paris Agreement effectively, put a cap on. So society, to sort of your point, has to galvanize around this, and we need to be able to ensure that there's sort of compliance in all of this. I saw that the SEC was going to sort of start to put into place a way that it could measure some of this, and companies had to account in a lot more stringent ways, and obviously with a lot more complexity, their CO2 footprint. But what about the oil and gas industry specifically? Like, what do you think that industry can do? And how can it sort of, I guess, in a sense, get creative with all of these different mechanisms and levers at its disposal? How does it respond?
Sure, sure. So, right, the industry is clearly taking different companies taking different tax, ranging from some of the European super majors that are getting very expansive in their definition of what they should do. And they're trying to position from being oil and gas companies to being energy companies, right? And investing heavily in renewables and hydrogen and the like. Um, and that's fine. That is absolutely that's a path, and it's one that the investment community debates as to whether that's the best use of capital. But that's a conversation, I guess, for another day. But at the bare minimum, an oil and gas company can focus in on its own emissions. Let's just call them Scope 1 and Scope 2. What can and many are obviously making commitments to limit their methane emissions along the path in production, for example. You mentioned kind of in a sense, how to integrate financial mechanisms into that, right? How does that help catalyze more of that behavior? And we do see some of that underway already. So the easiest example to look at is the certification of gas. And we're actually starting just now to see a little bit of certification of oil. But if I focus in on gas, roughly 5 BCF per day of gas produced in the US is now being certified, mostly out of Appalachia and the Haynesville. And what does that mean? The emissions are being measured and verified, and there is a emissions intensity being assigned to a MMSCF of gas. Now that is likely to prove to be important for commercial opportunities. So there are going to be buyers that want only low emissions intensity gas, and so that certification and being able to prove that it is going to become its own objective, right? In a sense, it's just going to be a cost of doing business, and that's fine. Markets, however, are developing, again, to sort of bring it back to the financial mechanism. S&P Global Platts and Xfinity, which is a carbon exchange. It's basically sort of a carbon-based exchange. They introduced a methane performance certificate. In that you see, you are actually on carbon offset. That's been trading since October. It's peaked at about $8 per metric ton of carbon dioxide equivalent. I think it's trading at around $6 a ton now. So in other words, the offsets, and of course, as a receiver of the certificate, the oil and gas company gets to sell that, and that helps to offset some of the costs of lowering its emissions, the investment in valves, investment in the LDAR, leak detection and repair, and the like. So you're seeing the financial markets kind of evolve to grease the wheels, if you will, offer a little bit of financial incentive to do that, in addition to the commercial opportunities I mentioned of selling LNG to European buyers. Now we can take that idea further. It's not that hard to kind of say, oh, all right, well, once you're already setting up mechanisms to put value on emissions reduction, you can take that further. I mean, one of the easiest things we've seen, and we've done a little bit of work on, which I'll describe, relates to plugging abandoned oil and gas wells in this country. So if you think about it, excuse me, this is a really easy one in our view. You have some 2 million, according to the EPA, some 2 million abandoned oil and gas wells, most without an owner. And so the government, as part of the infrastructure bill, has ponied up $4.7 billion to go find and plug these. Well, each one of these doesn't emit a whole lot of methane, but it is pretty easy to measure how much it does emit. And what studies have shown is that the emissions rate year after year is very steady. So all of a sudden you have a measurable, verifiable, stable source of, okay, if I plug this well, I will not emit these hydrocarbons, this methane, right? And therefore these emissions. Um, Now we did a little bit of work taking some studies that have been done in Pennsylvania. Mary Kang out of McGill University has done a whole lot of work with this over the years, and so we borrowed some of her data basically. And the math kind of works like this. So the average for a set of unplugged Appalachian gas wells that she studied, the average emissions was 0.66 metric tons per year um, of sorry, of methane, forgive me, using $14 per ton of CO2 equivalent, which is what the CBL nature-based carbon offset, which is sort of a US nature-based exchange, that's where things were trading at the end of 2021. We find that the carbon avoidance credit amounts to about 15% of the estimated cost of plugging and abandoning and site remediation of one of these given abandoned gas wells. So it doesn't cover all the costs, but it's a reasonable chunk. And again, if we think about it, this gives private investors, this gives the corporate community the chance to supplement taxpayer dollars. You'd be able to stretch taxpayer dollars to cover either more wells or to spend less money and provide a very actionable emissions reduction step. So again, the evolution of financial markets helping to catalyze, helping to mobilize more private investment. We really need to see more of those types of things.
Yeah. But for that, what do the financial markets need? Like, how do you accelerate that? Is it regulation? Is it a behavioral change? Is it I guess maybe a higher price? Do we need to start to set a price as a government define and hopefully create those incentives?
Well, I'm glad you're raising this point, because what I was just describing is all happening in the absence of any kind of government mandate or government overlay. So it's entirely relying on, whether it's the investment community pushing, but it's entirely reliant on industry and corporate saying, this is the right thing to do, let's do this, right? Or individuals, as you say, if you want to try to offset your own carbon footprint with airline travel, right? There can be mechanisms, and we can talk about how to foster those mechanisms too. But these get a whole lot more powerful if the government steps in and says, no, you have to cut your emissions by this much. Go figure it out, right? Or again, like we said in the beginning, you can do it that way, or you can say, well, we put a value as a government at $50 a ton, and maybe of CO2, and maybe that's going to rise to $100 a ton by 2030, whatever the rate is. But that makes the incentives a whole lot brighter and clearer and greater, and it starts to presumably catalyze a lot more activity a lot sooner.
Yeah. So do you foresee, or do you think, effectively you're sort of talking about a cap and trade system here, that ultimately, as the volume of those decreases, if there's a set price, the price should increase. You should always therefore have investor demand for a product like that. And you end up with social good in the sense of that reduction getting achieved. But fundamentally, companies in their core shouldn't just be about finding financial mechanisms in which to get their sort of emissions levels to what they should be, but actually make the structural, to your point a little bit earlier, make the sort of structural changes to valves and other sorts of things like that in order to actually remove and reduce the emissions forever, as opposed to just find a way to compensate for the fact that they're happening.
Sure. Sorry, yeah, I'll jump in. You're right. I think what I think I hear you getting at is the needling issue that people have with offsets in general, right? Some activists are very much against offsets, period, because what they want to see is great behavioral change, and they feel like offsets are kind of an easier way out. You pay a little bit of money, especially because now it really is a little bit of money, and that gets you off the hook, and you can come out and say, look, we are net zero or something.
Yeah.
I think that offsets are, it's controversial, I guess, as some of them are. I think offsets can provide a very valuable way to spread dollars around and to help address what will be very difficult challenges with respect to some real emissions reduction. So I don't
Yeah.
discount that it has value, but you're making this great point, which is that if nothing else, each of the offsets kind of needs to be evaluated for its relevance, for how valuable it is. I mean, look at the issues that people have had with forestry based ones, where people are getting supposedly paid to not cut down a tree that they were not planning on cutting down anyway, right? And so, how much is that really worth? And so I think you do need to look at each of the offsets on its own terms and validate that it has real savings, that it
Yeah.
offers real avoidance, if you will.
But the important part about them, I guess, in a sense, is that fundamentally, companies that don't have the financial ability to sort of invest in it, but perhaps have an easy path to being able to decarbonize, are, in a sense, given an avenue, because there is an opportunity for those companies that don't have an easy path, but have the financial wherewithal to be able to somehow sponsor, if that's the word, other organizations to help decarbonize. You end up with lower carbon, but you just need the mechanism by which that can therefore happen. And that requires sort of the sort of support and the role and the involvement of society, absolutely. And that we've seen a lot in the last 2 years change in the sort of the attitudes and behaviors, and certainly the years previous to that. But it also does require the sort of government and the financial markets to play a part. There's another sort of element to that, and that is technology and the role that technology can play in this, and specifically blockchain. I'm curious by, I guess, sort of your research or anything you've seen in this space.
Yeah, I appreciate the question, and it does dovetail really nicely with this notion of the marketplace and how it facilitates the marketplace. Because although I have not lived and breathed in carbon offset markets, I have read various things which suggest that they're not functioning really well today. First of all, there are several of them. That's a function of its nascent nature. So you have a lot of little ones, which is not the way you have effective markets, right? Because of a lot of little spots of illiquidity, and you're not gonna see optimization. I have also heard that various elements of them are, that they're not very transparent, that they're often very conflicting and different contractual structures, so that any would-be buyer has to spend a great deal of time and effort trying to understand what the terms and conditions are and to try to regulate that. And that makes it all very, very inefficient. And so when you talk about blockchain, that seems to create an opportunity, although it has to force a change in behavior. It creates a nice opportunity to expand markets, make them a whole lot more liquid. So now, your listeners have a sense of blockchain, I'm sure, but essentially what they are committed to is open source, transparent data, and in a sense, forcing standardization of various types of contracts such that they can essentially churn, you don't need individuals working on each element of them, if you will. And having established that, you can create a mechanism where you can start to tokenize. You can disaggregate contracts and offsets into smaller pieces and thus find much smaller buyers, thereby growing the number of buyers as well as sellers, presumably, and creating a much more robust marketplace. So one of the examples we've seen, which is trying to do just that, seems, in my sense, is it's successful, is ECO2 Ledger and its pilot in China. And essentially, it's doing exactly what I just tried to describe, with the additional overlay that they've created an app for your iPhone, which is called My Carbon App, and you create an individual profile, and it estimates your carbon footprint, and then by virtue of its connection with a specific carbon offset market, it gives you the opportunity to buy offsets to offset as much of your carbon footprint as you care to. And so all of that is contingent on blockchain in the sense that it is verifiable. You can feel good about it. It will stand up to scrutiny, and the contractual ease, which apparently, as I mentioned before, just doesn't exist today.
That model that you're talking about there, that's very much about getting the sort of consumer, the individuals, to take ownership of their their carbon footprint and their
That's right.
responsibility to sort of enable more decarbonization. Are they running anything similar? Maybe this is out of your knowledge base, but are they running anything similar to much more a kind of global corporate scale? I mean, I was aware that China does have a sort of an emissions market, but do you know much about that?
I think that there are several pilot projects handling different aspects of this. It just so happens that, in a report that I saw recently that was put out by one of the arms of the UN, that a number of the examples were in emerging markets. But I don't think there's any reason to think that that's exclusively in Eastern Asia or something.
Yeah.
But I can't give you another example of something that's a lot closer to home.
Yeah. Let me take you back to this sort of notion of price, if we can. You talked and right at the beginning, you said, prices can vary from $4 to $100, and it all sort of slightly depends. And the sort of this idea that transparency of price is a challenge is known the world over. And there are obviously local elements to it all. But does a carbon price need to be global? And would it be of value to society if there was a global carbon price because of whether it's issues in cross-border trade or just being able to identify and assess different projects and find incentives and ways to incentivize the whole world to be part of this? Do you believe that there is a path towards a global carbon price?
I think there should be. I can only imagine how challenging it will be to figure that out and to sort through that. Simply having a price in most countries of importance would be a great start. And then if there's arbitrage opportunities, then there's arbitrage opportunities. But at least that would be the starting point. But then, sure, ideally, you have that would really speak to the collective vision of the world that we have established, for good or for ill, that this price today is what's really relevant. And if we think about it's incredibly difficult to say what's the right carbon price, right? But if it's substantive enough that it affects behavior, that it really changes behavior, then that's what we need to shoot for.
Yeah. And so if this is so important for society, does this become bigger than Bitcoin? I mean, is this a market that could, fundamentally exceeds the traded market for traditional fossil fuels?
I I guess that's a great question, and I don't know. You do have overlapping issues. We talked a little bit before how some of the resistance to the notion of a market in general or offset markets was that you give individuals or companies that do have the wherewithal to change their behavior a different way to get there. And so, if anything, it's like, well, if you need to spend this much money in some way to both revamp your operations and then offset what you can't change, where does that fall in? And so I guess part of the answer to your question seems to lie within that mix. But also, candidly, maybe I haven't looked at this long enough. Maybe I just don't have enough perspective on the numbers and how important they are, how big they are.
Yeah.
So,
Yeah.
I think you've probably seen, whether it's the IEA or various organizations' estimates of how much the world needs to spend to move towards net zero in a practicable way. And if it's 5 trillion a year, if it's 7 trillion a year, I mean, these are almost mind-bogglingly large numbers, but the investment to net zero is completely massive. And so if carbon offset markets can help to smooth the flow of funds, get them into the right places, which is obviously much of the purpose, and it is even a small subset of that, then it's a very significant market. That's about as far as I can get.
Yeah, no, I think the world would probably Agree with you there. Good. Well, look, Brad, it was good to hear your perspectives and the work that you're doing there at the Payne Institute. It's a really important topic, and we need to create the right incentives and mechanisms for individuals and organizations to drive this change. As I said, it might only be 8 more years before we're at that 1.5 degree scenario, and in order to get there, we need the markets to do what they know how to do, and the engineers, to your point a little earlier, to know to do what they do, and that's get smart and creative, and governments and regulators to step in and be part of the solution too. So good to hear you. Great to hear your perspectives. Thank you.
Well, it was a pleasure talking with you. I really appreciate the questions and the thoughts. And yeah, it's so much of it really does seem terribly important and terribly exciting. And there's just, we're on the cusp of really creating a whole lot of opportunities around it. And hopefully that can all help, in addition to all these other things that you just mentioned. So yeah, but it was a pleasure chatting with you. So thanks.